Glad to know you're still with us. Teslim Shitta-Bey joins me right now for this conversation, the Managing Editor of Proshare. Thank you so much for joining me today.
Thank you for having me. Good morning.
Good morning to you too. Well, we've always known Tier 1 banks as FUGAZE, talk about FBN, UBA, GTCO, Access Bank, and of course we have Zenith Bank, until Proshare said, no, let's look at this again. You also didn't stop there. You went further to sort of change your criteria almost every year. First, why do we need a new classification beyond the regular FUGAZE, which a lot of us sort of know, especially in the financial market, and we sort of align with?
Okay, thank you very much for asking. Well, in 2013, AfriInvest came up with the concept of FUGAZE based on 4 criteria. They looked at the total size of the bank in terms of its assets. They also looked at the capital adequacy of the bank. Then they looked at the bank's non-performing loans. Those were the initial 3 criteria. Then they added, later on, they added a further criteria about a year after, which was bank liquidity. We were having a conversation in the research department in Proshare, and we said, why do we have just a fixed number of banks as Tier 1 banks? And why are they the same banks? I mean, anything could have happened over a decade. For instance, we've seen the acquisition of some banks. We've seen also some banks perform less than they did in their heydays. Why are they still considered as Tier 1? So we decided to dig in and research the issues. And we found out that upon research, the same criteria that AfriInvest used, we applied it. However, we just added one more criteria, which was a criteria on diversity. In 2021, McKinsey conducted a research and found out that board diversity was important to the sustainability of a company. And therefore, we decided that let's look at diversity of the board of these banks and see whether it's had major impacts on their performances. So we added the diversity criteria. Now, when we did that research in 2022, we found out that the FUGAZE were not necessarily the Tier 1 banks of yesterday. We had seen some banks drop from the position of Tier 1, while 1 or 2 came into Tier 1 categorization. And therefore we said, well, wait a minute, we might have something here. Yes, I'm happy that you're showing this particular chart because it does show the fact that there has been movements, even in just 3 years, in the ranking of banks. And we've also seen that some banks have fallen out of Tier 1, while some banks have just joined the Tier 1 category. Now, like I said before, we've done 3 reports. The first report, we used 4 criteria. Now we said, what if we expand the criteria a bit? What if we decide that, look, there are other things that are important, such as a bank's efficiency, such as its effectiveness. And we said, okay, let's look for proxies for these measures and add it to the mix. And that we did the following year in 2023, when we looked at the class of 2023 banks. We added about 5 more criteria to what we had earlier. And we saw that there was definitely a change in the status of the banks that were considered Tier 1. Interestingly, in 2024, we decided to add another 5 criteria. We added, for instance, the net interest margins of banks. We added the consideration of the risk of the capital of the banks. We added quite a lot in the pot. We added a lot to the pot and said, would it change anything? And yes, it did change something.
You're still watching Business Edge, and I have right here with me Teslim Shitta-Bey, the Managing Editor of Proshare. Thank you, Teslim, for staying with me.
Thank you very much for having me on the program.
Okay, so before we went on that timeout, you were talking about the 5 additions you made to the criteria in considering Tier 1 banks. I'd like you to land on that before we go on.
Yes, we thought that it would be instructive for us to know how Tier 1 banks actually performed in terms of their fundamental business areas. So we looked at the net interest margin of banks. And that basically addresses core issues of lending and receiving deposits. So we looked at the net interest margin of banks. We also added a further criteria of looking at the cost of risk of banks. How expensive is the risk of the bank's capital? We looked at that. We also looked at their cost-to-income ratio. Why did we look at a cost-to-income ratio? Because we wanted to know how well they were managing their cost operationally. And that was very instructive. As we go along, we might talk about some of the issues in the relationship between the cost of the bank and its income. That actually resulted into some banks moving up and some banks actually declining in our rating. We also decided that we wanted to look at diversity again because we had knocked off diversity in 2023. We brought it back in 2024 to look at the importance of diversity of the board. We also added another criteria. How many directors in the bank were independent, non-executive directors? Because globally, it has been considered that banks or institutions broadly that have very strong independent non-executive directors tend to do better than those that don't. So the proportion of independent non-executive directors on the board of the banks were considered a metric by which we will consider efficiency and effectiveness of board participation in running banks. So those were basically the new criteria we put in.
All right, so for the everyday Nigerian, really, what is the import of this information? What does it change for them? Or even for the banking sector, what does it mean for investors, whether they're existing or intending shareholders?
Okay, that's a very interesting question. Now, the more efficient a bank is, the better the bank is run, the better the opportunities for investors to earn income by way of dividends. For instance, if a bank has low non-performing loans, you're expected to see a bank that will have very good earnings. And those earnings will yield dividends for shareholders. So the shareholders seeing a bank properly run should be happy about seeing those banks run. Now, if the bank drops in its index, or it drops in its ranking, the first thing you want to ask yourself is, why did it drop in its ranking? Was it as a result of having worsening cost-to-income ratios, which suggests that management hasn't been too tight on cost? Or is it because their net interest margins narrowed? And that means, of course, that the cost of borrowing money or receiving money from depositors is significantly higher than it was in the previous year, meaning that in its core business of lending, the bank wasn't doing too well. However, if the net interest margins actually rise, then it suggests that the bank is doing quite well in its core business of lending. And that is important to the investor. I guess it's also important to the taxman, and it's definitely important to consumers of the financial services.
All right, Teslim, as you were saying earlier, I mean, if we can have the slide that sort of shows where the banks were in 2022 versus 2023, and now in 2024 up there, so we can just talk, sort of take another look at this now. We see a lot of changes here. For example, EcoBank was nowhere to be found in 2020, 2022 and 2023, but here it is in 2024. What changed?
A very interesting question. EcoBank in question is EcoBank Transnational Incorporated and not EcoBank Nigeria. That needs to be stated because the Nigerian operations of EcoBank Transnational Incorporated, ETI for short, has not been as enthusiastically improving as the group would have preferred. Let me put it mildly. But the Anglophone operations of ETI has done very well. They've done very well in English-speaking West Africa, excluding Nigeria. The bank has also had challenges with its operations in East Africa. But when you look at it overall, the English-speaking or Anglophone African countries, except Nigeria, have done so well that we've seen that in core activities of the bank, in terms of their net interest margin, in terms of their efficiency, cost-to-income ratios, they have done quite well, and that pushed them up in the ranking for 2024.
All right, let's talk about UBA and GTCO. They fell from first and second to fifth and sixth, respectively. And then we have Stanbic, emerging third in 2022 and 2023 PBSI ranking. But 2024, it's not there. I mean, how are the mighty falling? Which of the metrics sort of worked against these three banks that I just talked about now?
Okay, right. Thank you for the question. I do want to say quickly here that dropping from the ranking doesn't mean that the bank hasn't done well. And it doesn't mean that it hasn't performed admirably. What it does mean is that relative to its competitors in the same category, they didn't do as well as their competitors in the same category. But they did do well. You will see improvements in their various metrics, but it wasn't sufficient compared to competitors. Now, let me take the issue of GT Bank. One of the things that counted against GT Bank was the fact that it had a total asset size that was relatively small compared to its competitors in the Tier 1 category, based on Proshare's assessment. For instance, GT, I think, is just under 10 trillion naira in assets. And that's way below maybe a first bank holding company that has 20 trillion naira in assets. I need to say this too. When we did our first report in 2022, we decided to remove total assets from consideration. We said, look, what is more important? It's not the size of the bank. It's the efficiency and effectiveness and agility of that bank. And therefore, we felt that the total asset size of the bank tends to distort that metrics. However, after the report was released, several banks, their chief financial officers spoke with us and made a compelling case for the reintroduction of total assets. Now, given that, and given the relatively small size of the total assets of GTB, well, they call themselves GTCO now. So GTCO dropped. Another challenge GTCO had was actually its cost of risk. The cost of risk of GTCO was about 4.5%, if I remember correctly. The cost of risk of GTCO was therefore the second highest in the category of Tier 1 banks, after the 7% of one of its rivals. So that affected GTCO. But the bank did quite well in the 2023 financial year end. The bank did quite well. But relative to other banks in the same category, its asset size was small, at just under 10 trillion naira. And of course, its cost of risk also was relatively higher than its compares. Now, when you talked about, I think it's UBA. When you talked about UBA, the UBA problem was basically its non-performing loans ratio, which is also very important for the weighting and ranking of Proshare. The non-performing loans suggest how well you are able to recover monies you have lent out to businesses and individuals. UBA did well in terms of the size of its portfolio, but there were challenges concerning its non-performing loans.
Yeah.
So that's why. Then I think you talked about Stanbic.
Yes, that's the last one.
Stanbic also had a problem of size. It's a very efficiently run bank. On the parameters of efficiency and effectiveness of the use of resources, it's quite high. Unfortunately, in Nigeria, it's relatively small. We're looking at a total asset size of around 5 trillion naira, and we have banks that are 28 trillion naira, 27 trillion naira, 20 trillion naira. So I think its asset size also adversely affected it.
Okay, so in closing now, one of the things you said in your closing thoughts is that being overcapitalized is just as dangerous as being undercapitalized. In less than a minute, what does that mean?
What that means is this. You can have too little capital as a bank. As a matter of fact, there are two banks in the system that have negative shareholders' funds. In other words, negative capital to do their business. So you could have very small capital, and therefore you find it difficult to be profitable. You also find your business difficult to be sustainable. However, you could also have too much money. And we saw that in the consolidation exercise that occurred under Charles Soludo, and then subsequently under the Emir Mohammed Sanusi II. We saw very large banks misuse the resources available to them, and then they got acquired by banks that use resources more efficiently. I'm sure all of us remember the big name banks of the days, especially in 2009 to 2010, where Mohammed Sanusi II had to consolidate the industry. So you could have so much money that you don't simply know what to do with it.
Thank you so much, Teslim Shitta-Bey, Chief Economist and Managing Editor of Proshare. Thank you for your time and your thoughts on the show today.
Thank you for having me.